Gervais, thanks for joining me. I wonder if we could start by looking at two of the trends that you talk about in that book. So one of those is globalization, but the other is also deregulation of the debt markets. So could you talk a bit about what impact you think those two things have had on markets over the past 30 odd years, and how have they shaped markets?
Yeah, I think one of the key aspects of globalization was that as free trade opened up, the ability to import international goods from low-cost economies was such that actually you could import deflation. At a time when inflation has been so persistent, importing deflation meant that actually we've had a relatively benign period, probably for 30 years now, where inflation has been largely suppressed. And as a result of that, every time we've had an economic setback, we've been able to inject extra financial stimulus in the form of interest rate cuts or more recently quantitative easing, which has boosted the valuation of bonds. It's boosted the cash in the global markets. It's boosted the ability of companies to raise capital. And as that comes through, then you've seen asset valuations, stock markets moving up, but also global growth persist for an extraordinarily long cycle. So that's the first point, a long period of economic growth with benign inflation. The second feature has been that actually banks, just couldn't lend fast enough. They weren't industrially organised to lend at the rate which you could. As interest rates came down, people wanted to borrow more. They wanted to borrow in larger size. They wanted to invest more rapidly. They wanted to gear up financial structures. And effectively, that's meant that we've had a move towards quoted debt markets. Quoted debt markets are much larger now than the quoted equity markets, for example. And so this has meant that actually many companies now, they use debt routinely as part of their funding structure, and some of them work on the basis that they can always raise or roll over some of the existing debt when it expires, and continue to keep it as an evergreen facility, which is fine on the way up, but could become more problematic should trends change.
Yeah, and I mean, you wrote your book 6 years ago now. You made some bold predictions in it that things would change within 3 years. It looks like we are on the cusp of change, but I would say in the past 6 years, many of the problems you described in terms of the impact of deregulation of debt and globalization have perhaps become more pronounced. Do you think that's a fair comment, or?
Yeah, I mean, it's interesting, really. I suppose when you're talking about 3 decades, whether it happens in 3 or 6 years is perhaps a matter of detail. But most particularly, I think the pattern there, which basically involves active fund managers supporting companies which are not just appreciating, but hopefully appreciating faster than the stock market overall, tends to direct them towards those companies which grow rapidly, use plentiful cash to do so, and grow into global winners. I mean, big examples of that might be Microsoft and Apple, which have grown into companies which are now dominating the world and generating very, very substantial cash surpluses. And their valuations are very, very high, which has meant that in many cases the original investors have made out supernormal returns. So what we've seen is a lot of Me Too type businesses seeking to invest very rapidly, seeking to go for a large global position, running heavy negative cash flow whilst they build up. And they've got to a stage where they're in danger of falling between two stools. When you're growing fast, you have to put a lot of cost in to deliver on a global scale, but it may be a little bit longer before you get to your sales. And certainly if we now find that as inflation returns, sales never quite reach your targets, or indeed there's margin pressure and the margins on those sales never reach your targets, then you could find that actually you never get anywhere near to the position you look for and you actually fail as a business.
Yeah, so I don't want to say that you were predicting a fall of sorts, but do you think that the problems that will come with the changes you describe, the end of this sort of boom period of lots of debt and peak globalization, if that's the right word to use, will become worse than they perhaps would have been had the change happened, let's say 6 years ago?
We still don't know what's coming. I mean, we can make some assumptions about what's coming, and it certainly feels pretty uncomfortable just right now. But that doesn't mean we know what the outcome is at this stage. So what we can say, though, is there's more debt in the system than there was previously. And if anything, with the extra stimulus coming from COVID, and then to some degree around the time of the Ukrainian conflict, we're now in a position really where stock markets probably started at a higher valuation. Companies were more ambitious in terms of raising cash and running cash flow models than they perhaps were 3 or 6 years ago. And the risk on the downside of some of these vulnerable strategies is certainly as great as it was previously, and it may be greater. We'll find out later.
Yeah, and I think one of the strategies which you said would become risky as time went on was the sort of index fund or index ETF type investment that's become very popular over the past, I don't know, 10, 20 years, or really the cycle that you describe in the book. Can you talk about why you think index investors may end up being worse off, and why that's the case?
Yes, I think the key issue is that active fund managers have two jobs. One of our jobs is to make extra return, outperform perhaps some indices as a result of stock selection. But the other job of an active fund manager is to reduce risk, to moderate risk, to manage portfolios and diversify across different sectors and different holdings. And the whole point about index funds and ETFs is, to some extent, they're just not interested in diversification. They're not interested in managing risk. Really, their principal objective is to give you access to a certain trend, maybe gold stocks outperforming, or maybe a setback in perhaps the utilities market. So the effect of them is that they tend to be much more concentrated in terms of their risk. They tend to be holding assets which are much more correlated across the portfolio, as well as holding assets which might have very substantial weightings in individual holdings. And so ultimately, whilst you can get lucky in the same way that you can get lucky on the 330 at Plumpton, you can also get very unlucky. And I think that those people investing in some of those assets, not all, but I think generally quite a few of those investors probably haven't recognised the correlation risk or the stock-specific concentration risk, which I think will become more exposed as we move beyond globalisation.
Great. And I mean, reading your book, which I did over the weekend, I recommend anyone listening buy a copy, because it's still very interesting to read 6 years after publication, particularly today. I mean, one does get the impression that things have the potential to be a bit gloomy. And in a gloomy environment, I think people tend to think more about buying gold bars and hiding them under their bed rather than investing in companies. So, I mean, what sort of things do you think investors should be looking for in this new environment? How can they still get the returns they're looking for?
I think the first thing is to move beyond debt. Debt enhances on the way up, but if you're over indebted, it makes it doubly worse on the way down. And it's not so much that you can lose more money on the way down, but that you then run the risk of becoming insolvent. And it's not so much, again, even that you become insolvent, but effectively your equity investment, or even your bonds in some cases, you're forced to liquidate at the bottom, and there's no further recovery. So you're basically a forced seller at the bottom, and it's terrible losing money, but to lose it on a permanent basis and be a forced seller and someone else get the upside is obviously just not very attractive. So as a starting point, I think debt is not a good area to get involved in. When inflation is kind of pressing, the areas which tend to do better are physical assets. Now that often includes property, perhaps utilities, but it also includes commodities, things like mining companies and oil businesses. And so effectively the opportunity to invest in those kind of assets, which generate not just surplus cash, but hopefully reliable cash which can grow with inflation over time, is a good starting point. Ultimately, unfortunately, there is also going to be a risk that a lot of companies fail. Private businesses over-indebted, viable businesses but over-indebted, or businesses which have taken on too much ambition and are running cash flow negative models and run out of the ability to raise new capital. As those fail, one of the advantages of quoted companies, particularly quoted companies generating surplus cash, such as many of the UK stocks, is they can keep those businesses going by buying them from the receiver, albeit at distressed valuations, and possibly enhance their ability to generate surplus cash going forward. So actually the UK stock market, which has been very much a feature of caution and well positioned for inflationary times, has largely underperformed, as you know, relative to many of the international assets. But in comparison to the US, what we expect now is that the UK doesn't just outperform recently as it has. The FTSE 100 has already outperformed versus US markets already. But we expect to see this pattern persist and last and surprise in terms of the scale of that outperformance when it comes.
I mean, a couple of the areas that you suggest looking at in the book as well. I mean, one of those is smaller and perhaps also more niche companies. Do you think that remains true today as well? Are those the sorts of businesses that investors may find more opportunity with?
Yes, it's interesting, isn't it? I mean, the natural inclination is to assume when economic conditions get rough, that the small companies get have it tougher than the large companies. But actually, the great advantage of some small quoted companies is one that they have strong balance sheets. They don't have a lot of debt. But when it comes to acquiring assets from the receiver, specifically, if you're a big company and you acquire a certain asset A, a business which was viable but became insolvent because of too much debt, that will enhance the cash flow for a big company. But being a big company, it only incrementally improves their cash flow. If you start off as a small company, the great advantage is that the same transaction, buying asset A, actually leads to a much greater enhancement. So what bizarrely happens is if you invest in a company which is generating secure cash surpluses already, as a quoted company, it can then approach its shareholders, raise additional capital to buy assets from the receiver, and generate even faster, even more surplus cash per share going forward. And as that starts to become a pattern, then of course what tends to happen is the valuations of the small quoted companies starts to rise, and their ability to raise capital is easier, which means of course that the enhancement on those deals tends to grow faster. So from that point of view, if you go back to the 60s and 70s and early 80s, the UK quoted company sector, this is companies outside of the mid and large cap, I'm talking about small companies, some micro-cap companies, quoted companies don't just survive, as a group they thrive. They don't just generate returns, they generate better returns than most other assets. And that's particularly true as you move down the market cap range. So the micro caps on average outperform small caps, and small caps on average outperform mid caps, etc. So the UK is nearly unique in the world in being a stock market which has a heritage of dealing with inflation. That's why the companies are generating surplus cash, and we invest for incremental returns in terms of investment, and not high unicorns. But also it's a vibrant universe in terms of smallness and microcaps, and that's particularly after the bigness of globalization. Most investors need to rebalance their portfolio towards more smallness, and that's another area where the UK is almost unique relative to other stock markets around the world.
Fantastic. And I think, one other area that I also thought was very interesting was you highlighted the fact that investors should look for companies that provide outstanding service. I mean, is that something that you're still looking for when you invest at the moment?
One of the problems with the downturn is that often you find that competition gets tougher. So margins come under pressure. You've got a good business, but your competitors start offering the same service for a lower cost, or the same product at a lower cost. So how do you hold on to margin? And one of the one of the reasons for writing the book, and one of the things which helped us in terms of stock selection, was if you're going to resist margin pressure, of course you want to have a better product and invest in newer ideas and better sort of features and all the rest of it. But ultimately, you're still competing with lots of other companies, and we believe that if you are to hold on to margin, it's no use relying just on hopefully being slightly better product. You need to deliver not good but outstanding customer service. What's thrilling is when we talk to PLCs, is that how few companies, when you ask them, they say that they're interested in customer service, but when you start drilling down, actually not all of them are. A lot of management teams, you ask questions like what percentage of wallpapers might be involved in recording service levels, and they sort of make some general comment about, say, 10 or 20% or whatever. But then you can follow it up with a question, okay, well, what were service levels like last month? How do they compare with a year ago? Which is your best area in terms of service in your business as opposed to the worst area? Have you done any measures on some of the competition? And quite quickly, companies which are just not that close to customer service run out of answers, whereas those management teams which are really inspired about and kind of live and breathe the ability to deliver customer service stand out. And it's great because actually so few companies talk about this agenda in their annual reports or indeed in their company presentations to institutions. So it's an area where we can get real insight And in our view, it makes all the difference to selecting not just companies which are going to succeed, but companies which hopefully are going to be able to thrive in what may be a very uncomfortable economic situation coming up.
Great. And I mean, on the sort of day to day, have you had to rejig things at all or take any different approach given the sort of volatility we've seen in markets so far this year?
Well, we're always having to rejig all the time. I mean, what tends to happen is some share prices move up an awful long way, and they're good companies. They may continue to succeed, but the valuation starts to get to a stage where we think it's the right thing to start taking profits and reinvesting in companies which are more overlooked. So that tends to happen all the time. We also worry a lot about correlation risk. So holdings which have been successful perhaps become bigger holdings, and we tend to take profits on those and try and bring portfolio risk down so that each individual holding is relatively small and we're well diversified in terms of stock holdings and indeed sector weightings. We've also been very anxious really for the last 2 or 3 years about NASDAQ. NASDAQ has been a tremendously successful market, but we always feared that when inflation returned and investors became more anxious about market valuations, NASDAQ might be more vulnerable than other stock markets. So we've been very worried about companies which hold positions and operate in the same sectors as NASDAQ. And so we've tended to reduce quite heavily things like information technology, perhaps biotech stocks, because although they're successful, we think that when you get NASDAQ, and if you do get a change of behavior and people move capital away from some of those high beta strategies, we don't want to be caught in some of the existing holdings in the UK. They might be good companies. They might even not be standing on particularly high valuations, but they could be just caught in the downdraft. And so we've tended to move away from that into companies which are resilient, companies which are generating surplus cash. It's probably meant we've moved away from the consumer sector. We're involved in a huge range of industries and different industry models, but most particularly, hopefully, we believe that many of them are resilient in terms of customer service and balance sheets, but most particularly also in terms of the operation. They're not as affected by some of the other sectors where institutional selling may become more pronounced.
Great. And I mean, one thing I've noticed over the past month or so is that a lot of small cap focused trusts or trusts with some exposure to small caps have obviously been hit pretty hard. But at the same time, they're reporting pretty robust earnings growth and don't seem to be really performing poorly on the financial front. So do you think there's been any overselling, kind of panic-driven type stuff in the markets where perhaps fundamentals haven't really matched with share prices in a positive way?
Yes, I think, what tends to happen is when markets are unsettled, unfortunately some companies fall down faster than others. Some people don't want to sell the companies which have fallen the most rapidly, or perhaps they can't sell them. There's just no buyers there. And so they begin to sell other things, and that involves other companies which are more resilient, companies which aren't necessarily that expensive, but are liquid in that there's still some buyers there and they can sell some. And we've seen quite a bit of that. And I think particularly in the UK, you've seen the FTSE 100 hold up pretty well, but we've seen a lot of small companies, even some small companies producing good income with share prices which have been markedly weak in spite of good trading. And just this morning we had K3 Capital, for example, which is a company which we have a holding in our clients' portfolios, but most particularly it's a company which, it's not just trading well, they also have a business in there which helps with liquidations and receiverships. So if things get really nasty, that could find itself busier. But what's interesting is it's a well-capitalised company. It's got a strong balance sheet. It's generating some very good earnings. But most particularly, unusually, almost exceptionally, it's actually forecast its dividend for the forthcoming year at 15.5 pence of income. And its share price has been quite weak, and so it's yielding even now. It's up today, even on the dull day today. But with a statement, but it's yielding about over 5% according to Bloomberg on their forecasts today at 227. So it's extraordinary that you can find these companies which are the share prices just appear wrong. They mean slightly more wrong now than it was perhaps a week ago or a month ago. But I think that's driven by individuals who've just been unfortunate enough to have redemptions, to need to liquidate, and they've chosen to liquidate that because other holdings haven't been in such a good position. So
does that mean there's any opportunities in the market, even in this rather tumultuous period?
Yes. As an active fund manager, investors which are obliged to sell for reasons which aren't just rational. They're not just down to whether they think it's a bit expensive or whether they think there's a downgrade coming, but down to other factors, portfolio liquidations, perhaps being caught out with over large positions, or finding they've got too much correlation in certain areas. Does mean that they don't just sell stocks, but sometimes they can sell stocks in size at the wrong price. And of course, as an active fund manager, we are always really interested in the opportunity for being alive to those opportunities. It's not easy. We don't know whether the markets will go lower or whether they're going to go up next week. But what we do know is hopefully the companies we can select will hopefully be well positioned relative to others, and all being equal over time, if we get our stock selection criteria right, as I say, companies which are strong balance sheets, generating surplus cash, well positioned to acquire assets from distressed sellers if things get tougher, then we believe these companies will generate a plentiful return against an unsettled market going forward. And we don't. We've got to be careful about being too certain about the future, because we don't know. There's a huge range of outcomes that could come, but most particularly, we are very, very upbeat about the potential for UK assets, particularly UK quoted companies, which most people have been a bit cautious about. UK small quoted companies, which are very, very overlooked, and particularly small companies which are generating surplus cash, which have been out of fashion even during the good times, because people have been buying high beta sort of unicorn type stocks. So the bottom line is we're tremendously excited. Yeah.
Great. Well, I think that's a good point at which to stop. So thanks, Gervais, for taking the time to speak to me today. And thanks everyone for listening. We'll be publishing podcasts regularly from now on, so remember to check the Kepler Trust Intelligence website for any updates, and we hope you'll tune in again.